Well, time for some primary market action then. Transrail Lightings, the 840 crore IPO opens today for subscription. To talk you through the offering, we have with us the management in the studio. Hi, gentlemen. Thanks a lot for joining in. Well, the first basic question, right? You're raising some money. Could you tell us where is it going to be utilized?
Okay. So, we are raising around 839 crores, out of which 400 is primary.
Okay.
And in this, we're looking at 250 crores for our working capital. 90 crores for our capex to expand our 2 tower factories and 1 conductor factory, and 90 crores is for general corporate purpose.
Okay, all right. Just a quick couple of follow-up questions then. With this 250 crores of working capital, how does it ease things for you, in terms of number of days or in terms of working capital requirement, point number 1. And on this 90 crores of capex, what is the typical asset turn that you'll have?
Okay. So, for this, what we are looking at working capital, this will be purely used for working capital, so our net debt situation remains the same.
Okay.
And our incremental capex required will improve our factory capacity by 25 to 30%.
Okay.
So that is a brownfield project which we are in the existing factory looking at expansions.
Can you give us, do we have the order book number which you've shared as per the RHP, 10,200 crore, but that's of course not, it's a little post-dated, right, till September. What is the latest order book and your L1 position?
Ma'am, the numbers we have is as of 30th June.
Yes.
So it's around 10,100 odd crores, which is the order book, plus there are 3,200 crores of L1.
Okay, but this was as of June.
Yeah.
So as of, say, November end, what would the number look like?
Ma'am, we can't kind of, talk about the future numbers, but we are in a good zone, all I can say.
A good zone would be your L1, a pipeline could be quite good. So what are the projects that your L1, if you could quantify that? All in line with the regulations, sir.
Yeah. So L1 is 3,200. 90% of it is T&D,
Okay.
which is a core business, transmission and distribution. And out of that, around 50% is around international, 50% is domestic.
Okay.
So last year you grew pretty well. Your revenues went up by more than 30%. Is this the historical growth rate that the company has enjoyed? I just want to understand that if that's something that can continue, and if you can break up between domestic and exports, the international business, how are both those two segments growing for you? And is there any issue of receivables with either?
So we've been growing historically in the last 3 years with around 30% CAGR, which is something which we are very proud of. We have a very healthy mix of domestic and international. 60% is international, 40% is domestic, and both our segments are growing. International a bit more and domestic a bit less, but we see that both segments will continue to grow as what we see in the past.
And receivables?
Receivables are very much in control. Our net working capital days is around 75 to 80 days, which is as per the industry standards.
Okay, all right. Give us a few more details. Last year, if I look at it, the total revenues were around 4,100 crores is what you did. Now you have some capex that's coming on stream as well. So in line with regulations, you could tell us what is the revenue potential of the company as of now, post this capex. So 4,000 crores is what you've delivered, but maybe you have a potential of 6,000 crores. That gives us a sense about how you can grow without incurring any more capex. So if you'd give us that number.
So
I think we can safely go up to 8,000 crores of turnover with the increased capex and also the increased working capital which we are going to have. So safely it will go.
Okay.
So no need to incur any more capex. If the orders come, execution can safely go through. You can compound at a good rate in terms of revenue growth.
Yeah.
Okay. Are you confident about 30% sustaining over the medium term, at least that kind of run rate that you've enjoyed in the past? And also, if you could explain what led to the margin improvement. Now, FY23 margins were 9.5%, FY24 expanded to 11.7%, and in Q1, it's further gone up to 13.3%.
Correct.
So both those two, if you could talk about it.
Okay. So just to explain, we are fully backward integrated, which means that we make towers and conductors, which is around 60% of the requirement of a EPC job. Now, conductors is unique to us. Most of our peers do not manufacture conductors except one who's just started. And this gives us a competitive edge. Also, our international book is very healthy, as I said, 60% odd. where we have a margin profile better than the domestic profile.
How much better is it?
Well, if you see a margin profile at 13%, there would be notch or two better.
So international versus domestic is around 100, 200 basis points better?
Yeah.
Okay, all
And
right.
can you continue to expand margins?
I think our guidance is as per last year around, we did 11.77, first quarter is around 13, so it will be somewhere in between.
Somewhere in between.
So the strategic shift from predominantly domestic to international, where in 2020-21 we were doing only 20% of the revenue from the international market, and actually picking up the jobs internationally has actually helped us to improve our margin.
Correct.
Because almost all the jobs of international are multilateral funded and also having a price variation clauses. So any commodity increase, that has actually taken care. And actually we are very much engineering focused company. As a EPC T&D company, we are focusing on all the three important EPC, means engineering we are very strong. Procurement, we have got 60% of our own product which to used in our project, and construction again is a very much under our control. So we are actually controlling 90% of the cost.
Okay, and the ideal mix going ahead would be 50% each, or do you think, as you mentioned, sir, that you all were at 20%, which has now moved higher in terms of international revenue mix? Do you see that ratio even improving further in favor of international, or do you expect it to stabilize around
We
here?
think it's going to be balanced 50-50 because the domestic market also in T&D is growing, and that gives us a very good opportunity to look at project focused bidding, where we look at the margin profile, and that's our focus. We believe that rather than looking at revenue alone, we look at the complete risk matrix. So how do we improve our margins?
Got it. Okay, all right. Just one more quick question from an industry perspective as well. We hear that at various parts of the globe, there is some supply side issues. Now, you clarify that you all are partly backward integrated, which helps you all in terms of margins. Are there still supply side issues both for your company as well as on, for other competitors as well? Or are most of those supply side issues getting sorted?
Well, from a transmission point of view, we don't see any supply issues, either domestic or international. However, for substations, transformers, there has been a certain amount of supply-demand imbalance, which I am sure that the Indian industry is catching up in terms of capacities, and so would be the international markets. So it's going to get balanced out in the next few months.
Okay, just a quick word. There's an offer for sale of about 440 crore rupees. Promoters are bringing down their holding. By how much? What would the current promoter's stake stand at after the reduction, and why the monetization?
So the promoters today have about 82.5% holding, and after the post IPO, the promoters holding will get reduced to 71%.
Okay, got it. Thank you. Thank you very much, for joining in, and wish you all the very best.
Thank you so much for your time, and pleasure being here.
Well, and on the listing, we re-invite you all to join us, and at that point of time, we'll push you all a little bit more for a guidance from here on. But all the best, and we look forward to being in chat with both of you all.
Thank you. Thank you.
Well, getting back to the markets, when we